Hi, my name's Justin Bergner, and I'm pleased to be on the podcast today talking about the drivers of industrial stocks and some recent beneficiaries of the infrastructure bill. By way of background, I've been with the firm for 8 years covering industrial stocks. I've been in the industry for over 15 years as an equity analyst, and almost all of those have been involved in covering industrial stocks. I focus on multi-industrial stocks, electrical names, some transportation names, and some metal names as well. And in addition to my responsibilities as an analyst, I have portfolio management responsibilities on 2 of the 3 utility funds at the firm, as well as the dividend growth fund, which is a diversified fund.
All right, so the first question we have today is, how have industrial and multi-industrial stocks performed this year, and what are the drivers?
Sure, thank you. So multi-industrial stocks performed very strongly at the start of the year as interest rates went up, thinking about sort of the 10-year yield going up to around the 175 basis point range. They've given back some of those gains as the interest rates have come down and commodity prices have softened a bit after their recent run-up. In addition, some measures of industrial activity have begun decelerating from some very high levels. So the proxy that I use is the XLI Industrial ETF. It's a proxy for the sector and generally the larger names in the sector, and it's up 18% year to date, slightly below the S&P, which is up 19%, and some other higher beta sectors, which are up a bit more than the S&P.
And what are expectations for industrial activity, and how is that factored into the sector?
Sure. So industrial stocks, like most stocks, are typically valued based on forward expectations and sort of forward, earnings growth and momentum. At least that's how they trade. And so industrial activity actually has been exceptionally strong this year, but that has created the assumption that things are going to decelerate going forward. So the monthly USM ISM manufacturing index, it's a diffusion index, so it's a survey that tracks the respondents who see the industrial activity improving versus those who see it flat or declining. 50 is considered neutral, and above 60 is a very high number. And so the ISM manufacturing index has jumped above 60 and stayed above there for most of the year, which is a very strong number. And what that has done is create expectations that things can't stay this strong forever. And we're going to see deceleration as we look into 2022. Effectively, the industrial recovery has occurred faster, and it's pulled forward some of that growth. And there's going to be more modest growth next year with ISM numbers that are maybe sort of still growthy in the mid-50s, but not as high. And then the other part of the equation that is worth discussing is how industrial stocks trade relative to bond yields. I mentioned that bond yields declined, and that's led to some give back of the industrial stock performance. And yields are often accompanied by rising inflation expectations, and industrial stocks perform well in that environment, at least relatively speaking, because they're considered to be a pretty good hedge on inflation, and because many industrial companies have defined benefit pension plans where rising rates lower the present value of obligations under the plans, effectively creating a lower liability on the pension side, and that's often treated as a debt-like responsibility for the company. So that's another sort of key element of how industrial stocks have traded broadly year to date.
Which industrial stocks are performing well in this environment?
Sure. So if you sort of look at the last year or two of performance of industrial stocks, there have clearly been these fluctuations with macro drivers. But the industrial stocks performing well are those that have long-term secular growth drivers and a track record or an expected track record of being long-term compounders of earnings growth and free cash flow growth. So these compounder stocks in the industrial space have benefited from a low interest rate environment because they can raise debt at very low rates to invest internally or to make acquisitions. And in the current environment, because of their ability to raise money at such low rates, they're effectively being valued with a lower cost of capital, leading to multiples expansion alongside the earnings growth. So in that vein, automation plays have been very strong globally in this regard, including international names like Siemens and ABB and U.S.-listed Rockwell Automation. And until interest rates move up materially or some of the structural factors supporting automation growth dissipate, which is, effectively the secular phenomenon whereby automation replaces labor needs globally in many industries, these stocks are going to continue to trade at an elevated multiple.
And are there any names you like that fit the bill of secularly growing compounders?
Sure. We're obviously focused on stocks that have value characteristics, but one name that has been more value-oriented that we've liked in this regard and continue to like is Hubbell. Hubbell is a Shelton, Connecticut-based multi-industrial company, and the secular growth is to be found in its business selling power grid components, where it has a 25% or so share of a near $6 billion market, a share that's more than twice its next largest competitor. So they generate about $1.5 billion revenue from their power grid components business at about 20% EBITDA margins, and relative to the overall size of the company, it generates about 1/3 of its revenue, 40% of its EBITDA, and 50% of how we look at the private market value for Hubbell, given that it's a higher multiple business. And power grid components have been growing for Hubbell at a 5 to 6% clip for the last 3 years, at or slightly below the overall transmission and distribution CapEx growth that has been observed in the mid-single digit to high single-digit range. And this has been driven by grid hardening and resiliency investments due to some of the disasters that have befallen California and to a lesser extent other parts of the country with aged grids, as well as the build-out of renewables, which require more transmission and distribution. And the regulatory environment for utilities also is supportive because it incentivizes utilities to put through CapEx, now more focused on transmission and distribution, CapEx that they can earn a healthy return on.
And how about the rest of Hubbell outside of the grid business?
Sure. So Hubbell is a multi-industrial stock, and to complete the picture, their utility solutions segment, which is one of two segments, also has another $600 million of revenue from their Aclara metering business, which they acquired in early 2018 for $1.1 billion. It was, if not the largest acquisition, certainly the largest acquisition they've done in the last decade. This business does automatic meter reading for electric meters, also to a lesser extent water and gas meters. It competes with the likes of Itron and Landis and Gear. There's also a smaller distribution automation piece in Aclara, which is becoming more important and will be something to watch with time. And then the other half of Hubbell's revenue is in its electrical segments. That's close to another $2.5 billion of revenue. They provide electrical components across many end markets: commercial, industrial, construction, energy, and the lighting markets, where it's both components and fixtures. These businesses are clearly more cyclical. They generate lower EBITDA margins, sort of near the mid-double-digit range. Although Hubbell is a solid player with good operations, there's a bit more non-residential exposure there, which is not as strong of an end market because of some of the more remote trends that have taken hold more sharply over the last year or two. Hubbell also has a history of making very successful bolt-on acquisitions in its electrical business, and recently it's done some interesting bolt-on deals in utility solutions.
And for Hubble, how's the $550 billion Infrastructure and Jobs Act a benefit to their power business?
Sure. So that was something we recently looked at in detail. Before the act was passed, at least by the Senate, there was not a lot of clarity that was available publicly on the power portion of the Infrastructure and Jobs Act until it was passed by the Senate. And it was a $73 billion figure of grants and increased loan authority, but it ended up being fairly diffuse with modest grid spend. So about 17 of the 73 billion is directed at grid grants and R&D, primarily in the area of grid resiliency. This is about 23% of that $73 billion figure. Before seeing the detail, our expectations had been that closer to half of that $73 billion figure would be focused on transmission and distribution spend. Within the $73 billion, without changing the subject too much, there were some portions for clean hydrogen, carbon capture, battery technology, and other areas of interest. So it was a pretty diffuse, set of spending priorities. And that $17 billion figure is not that high. Earlier this year in April, the DOE, for example, announced $8.25 billion of grid reliability loans, not grants, but loans. And so, at that point in time, that was considered, a decent number, but nothing to sort of shock and awe people.
And what drives your optimism in Hubble's growth drivers outside the infrastructure bill?
Sure. So I guess there's been strong and continuous growth in grid spending even before it looked like the infrastructure bill was going to make it across the finish line, which we're close to, but we haven't quite gotten to. And so, the grid spend in the infrastructure bill did somewhat underwhelm my expectations, but there's still a strong outlook for utility grid spend. Utilities, provide a lot of detail about their CapEx plans, and they've indicated CapEx intentions for transmission and distribution spend, independent of what's in the bill, that suggests continued mid-single-digit to high single-digit growth. Also, while folks are focused on the utility grid spend of the bill as it relates to Hubble, there is a reconciliation bill around the corner currently at $3.5 trillion that looks to have strong incentives for electrification of buildings and increased renewable spend factors, which would aid Hubble's electrical segment and the transition build out for new transmission lines for their utility business. Also sort of independent of the $550 billion bill that passed the Senate. The risk would be if inflation lowers utilities' ability to put as much transmission and distribution CapEx through, or if that transmission distribution spend is heavily oriented towards the undergrounding of distribution. There are fewer components when the grid or when the distribution is built underground than it is above ground, although Hubble does still participate.
And how do you think about valuation?
Sure. So Hubble's stock, as I mentioned, has performed strongly, up about 32% year to date, and we don't want to suggest that it is a very cheap name today. It trades at about 14 times 2022 EBITDA and 21 times 2022 earnings. At the same time, it should generate, high single-digit earnings growth even after the sort of accelerating portion of the cyclical rebound. And you can couple that with the 2% or near 2% current return, and that gets you a double-digit total return, which speaks to the compounding nature of the business. We think it can preserve a high multiple given that it's well managed and it deploys capital well with a long-term time horizon. For compounders and stocks with secular growth, one can look out more than a few years to judge the valuation, the discount to the private market value, which is how we approach Hubble.
And what other names do you like that have exposure to the infrastructure bill? Any that haven't run up as much year to date?
Sure. A second name we like in this vein is Arcosa. Arcosa has a small portion of its business exposed to utility grid, through its Meyer transmission pole business. That's only about 10 to 15% of the revenue and the value of the company. What's more important as it relates to the infrastructure bill is the 2/3 of the company's value in its construction products segment. And within the construction products segment, about 3/4 or 75% of that is tied to construction aggregates, where it competes with larger players like Vulcan Materials and Martin Marietta. So about 50% of the value in the business now, after a series of acquisitions over the years, is in construction aggregates, an area of, focus in the Infrastructure and Jobs Act. The stock has had a good multi-year run since its November 2018 spin-out from Trinity Industries, a rail car company, but it's underperformed year to date, down about 6%, reflecting very weak conditions in its barge construction business, the departure of a well-liked CFO for another opportunity, and a modest sort of sell-the-news reaction to the infrastructure bill.
And why do you think these challenges at Arcosa are temporary?
Sure. So Arcosa's construction aggregates business, stands to benefit from a doubling of roads and bridges spending under the infrastructure bill over the next 5 years, just like its larger peers, Vulcan, Martin Marietta. While the barge business has been very weak, it has about a 2/3 share of the barge construction business. I mean, it's almost a near monopoly. And that's going to eventually cyclically recover. It may take a little while, but liquids production for liquid barges should, fully resume and regain its prior peak. And dry barges, which primarily serve the agriculture and coal end markets, are in need of replacement, but that replacement has been stymied by very high steel prices, which are at unsustainably high levels. And when they abate, that should lead to some resumed barge demand. So as a near monopoly producer, Arcosa should be able to make good money in its barge business when markets recover. The company was fortunate to have a capable replacement for the departed CFO in long-term controller Gail Peck, who assumed the CFO role. Certainly I would have loved if the prior CEO hadn't left, but Gail is a capable replacement. And from a valuation perspective, the company is now very cheap. It trades about 10 times, our estimate of 2022 EBITDA. The larger pure play aggregate names, Vulcan Materials and Martin Marietta, trade at 16 times. And we think over time that difference should halve. We don't expect Arcosa to fully narrow that discount. And we think that multiple can halve even when considering the contribution from all the other businesses outside of construction aggregates, which comprise about half the value in Arcosa. So the company's multiple is just much lower than should be reflected based on the company deriving half of its value from its construction aggregates business.
Are there any other stocks you want to highlight today?
Sure. Those are the two stocks that we've focused on that are heavy beneficiaries of the infrastructure bill and still have good value characteristics. But since we're talking about power, let's briefly touch on a stock that touches the global wind industry in a very attractive way. So Timken, the bearings company in Canton, Ohio, makes large tapered roller bearings, which aid the spinning of large wind turbines, as long as other components that go in the wind turbine. And that stock is also down year to date after having a strong 2020. And its renewable business, which is mainly tied to wind turbines, but also has a modest stream of solar-related revenue, it comprises about 12% of revenue in EBITDA and has been growing at a double-digit clip alongside, and maybe a bit faster than wind capacity and spending globally. Most of this exposure on the wind side is international, including in Asia, and particularly China. And what stands out is that the components that Timken provides for the wind turbine are not commoditized. In fact, they're a lot less commoditized than the turbines themselves or the wind towers upon which the turbines stand. And the components Timken provides are critical to the effective functioning of the wind turbine and will eventually have a pretty good aftermarket stream. in about 5 years. So Timken is growing its share on the wind turbine as larger turbines coalesce around tapered roller bearings, where Timken is a leader. And this is a really good business long term, but it's actually been a headwind for the company this year. So global wind installations and spending is still growing, but that spending growth has been modest. There's been a tapering of subsidies in China after a huge increase in growth last year. And there's also been supply chain constraints around the world. I mean, we hear about this across the industrial space, but they've affected the wind industry more given the large nature of the components that are being transported and logistics being sort of the most acute area of supply chain pressure we're hearing about. So this planned spend has just not been able to sort of go off in a timely manner. But it's a really good business long term and one of the better businesses serving the wind end market. So Timken trades at just over 12 times, about $6 of 2022 earnings power, about 9 times 2022 EBITDA. It has a history of market outgrowth, strong operational execution leading to industry-leading margins and good capital deployment. The reconciliation bill, which currently stands at $3.5 trillion in size, could provide meaningful incentives to renewables, which could be a tailwind for the portion of Timken's global wind business, which serves the U.S. markets.
You've talked about a number of industrial stocks today. Any closing comments on what you generally look for in an industrial stock?
Sure. So for industrial stocks, we try and keep the approach and the formula pretty simple. Find companies with decent end markets that can outgrow those markets, operationally deliver with strong margin performance, and which have a good record of strong capital deployment. Sometimes the company may be not outgrowing its end market, but it might be exposed to secularly growing end markets where it has the wind at its back, like automation and power grid spending. So we look for those situations too, where there's pronounced sales growth and good incremental margins, and then we try and find entry points where the stock trades at a material discount to its private market value, and we're always looking for catalysts for the company in terms of capital deployment or regulatory or otherwise, which could aid the performance in the stock over the medium term.
Several companies were mentioned in this episode. Our company owns less than 1% of the following: the XLI Industrial ETF, Timken, ticker TKR, Landis Gyre, ticker LGYRF, Martin Marietta, ticker MLM, Vulcan Materials, ticker VMC, Siemens, ticker SIEGY, ABB, ticker ABB, Rockwell Automation, ticker ROK, Hubbell, ticker HUBB, and Arcosa, ticker ACA. Following today's discussion, I must read the following disclosures. Equity investments are affected by market conditions. The intrinsic value of the stocks in which our portfolios invest may never be recognized by the broader market. The opinions expressed are current as of August 26, 2021, but are subject to change. The information provided in this podcast does not provide information reasonably sufficient upon which to base an investment decision, and should not be considered a recommendation to purchase or sell any particular security. Portfolio holdings are subject to change. The performance of any single portfolio holding is no indication of the performance of other portfolio holdings of any strategy or fund. Comments made on any individual company or stock is not an indication that it is currently held in a portfolio, nor is it an indication that it will ever be held in a portfolio. Thank you for listening to the Gabelli Podcast, and tune in next time for the latest in market updates and fundamental research.